Morning, last class, where did we started? Number one, if the ESOP is announced and exercised in the same financial year, we pass the same, entry. If there is no vesting period, if there is no vesting period or vesting condition, like 3 years of employment, 2 years of employment, like that, if there is no vesting condition at all, then what do? We just charge the, expenses as it comes. Bank account debt or employee benefits to equity, share capital, securities, premium, like that. Whatever is the expense that is recognized in which account? P&L account. Suppose if there are certain vesting condition. What do you mean by vesting condition? The condition to be fulfilled to exercise the option. If that thing is there, we will write off that cost over the period of vesting. Okay, for example, if the vesting condition is like 3 years, whatever is the cost you work out and write off over a period of what? That 3 years or 2 years or 4 years, like that we had seen. How to pass a journal entry also we have done, right? Employee benefit expense account or to ESOP outstanding. That will be charged in which account? P&L account. Like that, every year we create an entry. Then when options are exercised, what is the entry we pass? Bank account debtor, ESOP outstanding account debtor to equity, share capital and securities premium. For the options not exercised, lapsed, we transfer it to which one? General reserve. We transfer it to general reserve. I hope we have done question number 1, 2 and question number 4. Huh? Which question we have done last class? 1, 2 and what? 4. Now read question number 3. P Limited granted options for how many employees? 8,000 shares. Nominal value is how much? 10 on 1st October when the market price was 170. The vesting period is how many years? 4.5 years. 4,000 unvested options lapsed in 2012 itself. 4,000 options lapsed in which year? December 2012 itself. Then 3,000 options are exercised in what? 30th September 2015. And 1,000 vested options lapsed at the end of the exercise period. Okay. Please understand the question first. How many equity shares are offered? 8,000 equity shares are offered. What is the period of vesting? 4.5 years. So from October 2010, you have to wait for 4.5 years. You have to wait for 4.5 years to exercise the option. In that 4,000, unvested means before that 4.5 years is complete. Before the 4.5 years is complete, this is lapsed. What is the meaning? Probably they would have left the employment. Probably they would not have fulfilled the vesting condition. So they are maybe they would have left the company. So 4,000 options lapsed before even that 4.5 years expired. Then out of 8,000, wait. What is the total options? What is the total option given? 8,000 options. During the vesting period itself, how many options lapsed? 4,000 options lapsed. And after the vesting period is over, 3,000 options were exercised. 3,000 options were exercised and 1,000 vested options lapsed. What do you mean by 1,000 vested options lapsed? Understanding the question matters a lot than the passing journal entry. Okay, probably I'll give an Excel working so that you will understand better. When options are given? 1/10/2010. What is the time period? 4.5 years. So vesting period ends on, tell me when the 4.5 years will end. 31st March 2015. Okay, from 1/10/2010, you would add, count how many years? 4.5 years. Otherwise 4 years and 6 months. So options or otherwise vesting period ends on what? 31st March 2015. Okay, now if you look at on 31st March 2012, on 31st March, okay, 2012, whether the options vest or yet to vest? Yet to vest. So unvested options lapsed. Lapsed means they are not exercisable. Maybe they would not have fulfilled the conditions. How many things? 4,000. So how many options are given? 8,000. So out of 8,000, before even the 4.5 years condition period, 4,000 options lapsed. Remaining, how much will be there? 4,000 options are there. Then in September 2015, how many options exercised? 3,000. Balance lapsed. Balance, it is called as vested options lapsed. How many options lapsed? 1,000 options lapsed. Please remember, this is unvested option. What do you mean by unvested option? Vest means you're eligible to subscribe or you're eligible to buy. Before even the eligibility comes, these options lapsed. Okay. What do you mean by vested options lapsed? You're eligible to buy, but the employees are not buying. Is it compulsory to buy the share? No. Okay, so this is unvested options lapsed, like that it is given. So, and please remember, the expenses will be recognized during which period? Yes, expenses will be recognized. Expenses on ESOP will be recognized during which period? This 4.5 years period. This 4.5 years period is where we are going to write what? The expenses. We are going to write the expenses. So please take this. We will see how to write the expenses, how to pass a journal entry year-to-year basis. Take up this first. This is not a solution. This is understanding the problem in a better way. We'll see. Negative varadu, we'll see. We have to cancel that whatever is created for uninvested options to general reserve. We'll see. First take up this. Understand the question. Understanding the question matters a lot because it's an old theory that if you understand the question, it is 80% solved. Right? We have announced options on 1/10/2010. Okay, on 31/12/2000 itself, before even the 4.5 years complete, 4,000 options lapsed. Okay, the vesting period means the condition to be fulfilled till 31st March 2015. Okay, so 4,000 options are remaining. Out of that, people purchased only 3,000 shares, remaining options lapsed. But expenses, please remember, should be recognized based on which period? Vesting period. Okay, what is the fair market value of the share? What is the fair market value of the share? 170 minus ESOP price 80. So fair value is how much? 90. We are going to do accounting based on this fair value. Note that also. When our first financial year ends? Okay, start. For the year ending 31st March 2011. 1st October 2010. How many months? 6 months over in the current year. Otherwise, 0.5 years out of 4.5 years. So during the current year, the vesting period covered is 0.5 years out of how many years? 4.5 years. So as on 1/10/2010, we know how many options are outstanding. This cancellation we will come to know only on 31st March 2012. As on 1/10/2010, how many options are outstanding? 8,000 options are outstanding. We will create a provision based on that. So 8,000 options into what is the fair value of the option? 90 into, for this period, 0.5 by 4.5. 0.5, that is half year is over out of 4.5 years. This will be the expenses to be recognized for the current year. What is expenses? 80,000. What is the journal entry you will pass for this? Employee benefit expenses, or you can say employee compensation expenses or employees cost. Any word you can use. How much? 80,000. This you will charge it in P&L account. What is the journal entry for that? P&L account data to employee benefit expenses or employee compensation expenses, all means the same. 80,000. This is on 31st March 2011. Take up this. Then we will proceed. Year to year we will proceed so that we will understand in a better way. Next year end also simple. For the year ending 31st March 2012, the period of 1 year is covered. So we will charge 1 out of 4.5, 1,60,000. Any doubt in it? First year only 6 months period is covered. Proportionate expenses 80,000. Second year 1 year out of 4.5 years covered. So proportionate expenses how much? 1,60,000. As on 31st March 2012, we know how many options are there? 8,000 options are outstanding. The cancellation or lapsing of options we do not know on 31st March 2012. So let us create a provision. Let us assume you are preparing accounts or finalizing accounts on 31st March. On this day, how many options are outstanding? 8,000 options are there. Subsequent cancellations are lapsing, we will see later. Any doubt in it? Any doubt in it? Please ask. So how many years over now? 1.5 years over. Then for the next year, we cannot directly pass an entry. For the year ending 31st March 2013, of course, 1 year period is covered. But before that, before the end of the accounting year, something has happened. Look at that. On December 2012, how many options lapsed? 4,000 vested options lapsed. Unvested options lapsed. Okay, 4,000 unvested options lapsed. But we created a provision for this. For the past 1.5 years, we were creating provision based on what? 8,000 options. So when the unvested options lapsed? When? 1st December 2012, which falls in financial year 2012-13, for the unvested options lapsed. How many unvested options? 4,000 options. What is the provision created? Into 90 into 1.5 by 4.5 we created in the past. 4,000 options lapse. What is the fair value? 90. What was the provision created in the past? First year 6 months, next year 1 year. 1.5 years out of 4.5 years created. This excess provision to be removed. Excess provision to be removed. How to remove it? We know it already. Will you transfer to P&L account? No. It should be transferred to which one? General reserve. Simple. Pass the entry. ESOP outstanding account data to general reserve account. So we remove that. Unvested options lapse. So whenever options lapse, or whenever the options are not exercisable, or whenever the people say I do not want, or whenever the people say that we do not want to exercise the option, or they don't fulfill the condition, service condition, etc. You just transfer or cancel to which one? General reserve. You transfer to general reserve. If you don't do this, it will be like creating an excess provision. You are continuing with excess provision. Having known that fourth option options are not going to be there, you create what? An excess provision and maintain the provision. That is not good.
Mathematically correct amount.
We are not here for mathematics. Think logically. Think logically. How many employees are there on 15th December? I mean, how many options are outstanding on 15th December? 4,000 options only. So you cannot carry a provision more than what? For that 4,000. That's why we cancel it. Excess provision created, cancel it. Suppose if we come to know that only after the vesting period is over, then after that 4.5 years, you can transfer to general reserve. We know that on 1st December itself, these 4,000 options are not exercisable. Whatever is excess provision created in the past, transfer to what? General reserve. Next. On 31st March 2013, on 31st March 2013, on 31st March 2018, now how many options are there? The remaining 4,000 options are there. For that, let us create a provision. 4,000 options into 90 into 1 divided by 4.5. This is for the current year. What is the journal entry you will pass? Employee benefit expenses account data to which one? ESOP outstanding account. This is for the year ending 31st March 2013. We cancel the options. For the remaining options, we passed and we transfer it to P&L account. This will be charged in P&L account. Okay, sorry, employee compensation expenses. Ensure to maintain the same thing, bro. Next. For the year ending which one? 31st March 2014. Yeah, 4,000 options are there. For this year also, you will pass one more the same journal entry. Done. So finally, for how many options we created or passed the journal entry? 4,000 options. You can check by either by preparing a ledger account or you can do a statement also. So 31st March 2013 or 2014, how many options are there? 4,000 options are there. We pass a journal entry based on that 4,000 options. Done. Now let us cross check. Let us cross check. First year, what is created? ESOP outstanding 80,000. Second year, how it is created? 1,60,000. In that third year, we cancelled. We cancelled how much? 1,20,000 and created how much? 80,000. Fourth year, how much is created? 80,000. So by, okay, fifth year, we created 80,000. Right, 4.5 years. First year only how many months covered? 6 months period covered. First year 6 months period covered. Second year we created 1,60,000. Third year we cancelled this. We cancelled this excess provision, created 1,20,000 and created 80,000 for the current year. Fourth year, fifth year. One more year we have to continue. Yes. One more year, repeat the entry. 31st March 2015. Okay, that is the date on which that 4.5 years complete. 31st March 2015, right? So pause, repeat the entry. If you look at the total amount, 3,60,000 will be there in which account? ESOP outstanding account. In ESOP outstanding account, you will have 3,60,000. You can cross check also. How many options are there as on 31st March 2015? Out of 8,000, 4,000 cancelled. 4,000 options into what is the fair value? 90. 4,000 into 90, 3,60,000 will be there. Any doubt in it? Shall we? When the options are exercisable or when the options are exercised, check the question. September 2015. So during September 2015, that is in the next financial year. For the options exercised, what is the journal entry you will pass? Bank account debtor, pass entry. ESOP outstanding account debtor. To securities premium. Whether 4,000 options are exercised? No. 3,000 into how much the shareholder will pay or employees will pay? 70. 3,000 into 70 will go to bank account. 3,000 into 70 will go to bank account. The fair value of the option, 3,000 into 90 will go to what? ESOP outstanding account, debited with ESOP outstanding account. To share capital will be, what is the face value? 10 rupees. 3,000 into 10, 30,000. Balance will go to securities pay. For the options lapsed, how many options lapsed? Vested options lapsed. What is the entry you will pass? ESOP outstanding account debtor to general reserve. That is for the 1,000 options into 90. Yes, we had an accumulated balance of 3,60,000 ESOP outstanding. In that 2,70,000 is used, remaining 90,000 worth lapsed to transfer to which account? A general reserve account. This is during which financial year? Once again, repeat the entire process for a minute, paying attention. First, the period covered is only how many months? First period, the covered is how many months? 6 months. So we create a provision 0.5 by 4.5 based on how many options? 8,000 options. Okay. Next year also, we create 1 out of 4.5 years. 1 by 4.5 we create based on 8,000 options. Before the end of the next year, how many options lapsed? 4,000 unvested options lapsed. 4,000 unvested options lapsed. Cancel the provision that was created. Having known that clearly that these options are not exercisable, maintaining a provision is not proper or fair. Okay, so cancel that particular thing to general reserve. Then on 31st March 2013, based on the remaining options, we create a provision. Next 2 years also we continue the same. We reconcile, yes. At the end of the vesting period, we've got 4,000 options. ESOP outstanding will show a balance of how much? 3,60,000. Okay, in that 3,000 options are exercised, use it. Remaining 1,000 options lapsed, transfer to which account? General reserve account.
80.
ESOP price is 80. Yeah? Okay, with 80.
Here, the 4 lakh 80.
Okay. Changes. Changes, okay. It's a very good problem. This can be tested for about 6 to 8 marks in the exam. For this chapter also, if you are completely or thorough in this particular classroom discussion, 90% of the learning is over. Then we can go through the past asked question that is annexed to it. You can find the same questions are repeated with different numbers, that's all. Shall we? Shall we proceed? Okay. Over. Live online friends, shall we continue? Copy பண்ணிட்டீங்களா இல்லையா அதான் சொல்லு. No, okay, fast. See, let it be vested options lapsed or unvested options lapsed, the same journal entry. Because accounting is which one? ESOP outstanding. We will transfer to which one? General reserve. Done? Fourth question we have done in the last class. Okay. We'll do the sixth question, then we'll come back to fifth question. We'll do the sixth question. One of the most important question and most repeated question, not only for CA Inter, it is there in CA Final also, but the chapter name is called as share-based payment. You will discuss in the form of Ind AS 102 share-based payment, but accounting is same. Okay, ESOP and share-based payments it becomes, but it covers something extra also, and it is there in any course, CMA or any course you find this question will be there. Wait. Normally, vesting period is, so far we had seen a fixed vesting period. What do you mean by fixed vesting period? What do you mean by fixed vesting period? 3 years, 2.5 years, 1.5 years, 4.5 years and all we had seen. Now, can the vesting period change? Can the vesting period be changed subsequently? For example, listen, don't go to the question as of now, just understand. Let us assume we are in which financial year? 22-23 financial year. Let's assume options are announced on 1/4/2022, telling that if profit after tax of 2022-23 and 23-24 financial years exceeds in total 600 crores, then options are exercisable. Okay, if that condition is not fulfilled, second condition is part of 2022-23, 23-24 and 24-25 totally exceeds 1,000 crores, then options are exercisable. First 2 years, what the company should earn totally? First 2 years, 600 crores if you earn, the options are exercisable. Then, if that is not met, for example, second year end you work out, it is not coming to 600 crores. Okay, then the options are exercisable in the third year, provided that 3 years profit exceeds how much crores? 1,000 crores, not 100 crores, 1,000 crores. Okay, let us assume actual position. On 1/4/2022, we'll estimate based on what? Based on how many years? We are on 1/4/2022. We'll estimate based on what? 3 years period or 2 years period? Profit after tax of the 2 years exceeds 600 crores and options are exercisable. Then on 1/4/2022, estimate will be based on how many years? 2 years. Estimate will be based on 2 years. Okay. Maybe 31st March 2013 I keep. 2023. Estimate will be based on how many years? 2 years. Let's assume on 31st March 2024, profit after tax of the last 2 years, 590 crores. But what is the condition? Options are exercisable after second year if the profit after tax exceeds 600 crores. But for 2 years cumulative profit, we saw actual position we know 22, 23, 23, 24. Actual position is known on 31st March 2024. What is the profit after tax? Only 590 crores. Whether options will be exercisable now? Now the vesting period will get extended to 3 years. Initially you thought after how many years? 2 years. But subsequently it is extended to how many years? 3 years. And we are estimating that next year sales is going to be like 600 crores. Now, 31st March 2015, let us assume if the turnover or profit crosses 1000 crores, then option becomes what? Exercisable. Option becomes exercisable. Simple. This is to tell you that the vesting period can change. Initially, we thought 2 years. That is extended to how many years? 3 years. It can extend to 4 years, 5 years, 6 years, depending upon the vesting condition given. Now, how to create a provision? Is it possible to accurately measure? First year will be estimate based on how many years? First year we will estimate employee stock option cost based on how many years? Amortize based on how many years? 2 years. But by the end of second year, you will know options are not accessible in the second year. It is accessible only in which year? Third year. What to do? Then we have to apply a cumulative method. We'll apply a cumulative method. How to apply this, sir? We'll directly go to the example. Journal entries are same. Journal entries are not going to be different. When options are created, what is entry will pass? Employee compensation account data or 2. There is ESOP outstanding. Then charge it in P&L account. When the options lapsed, okay, transfer to general reserve account. That and all is same. Entries are same. Only estimates are going to be different. How to do it? We'll see. One of the fantastic question number 6. Read the question at least 3 times. You must read the question at least 3 times, understand it, then only we can solve it. It's a full story. It is nothing to do with accounting rule or accounting concept or some accounting standard. Pre-written rule, nothing is required. Logical thinking is only required. Only a logical thinking. So 100 stock options for 1000 employees. Initially, how many stock options will be there? 10,000 into 100 will be what? 1 lakh stock options. How many stock options? 1 lakh stock options. Look at options will be exercisable within year if it is vested. You can exercise it within year if it is vested. The market price of the share is 50. Option at the end of the one is exercisable if earnings of choice limited is how much percentage? 16%. First year and you can buy the share provided if earnings of the company is how much percentage? 16%. Look at earnings are only 14%. So whether options are exercisable at the end of the first year? No. Or it will vest in second year if the options are the average profit is how much percentage? 13%. Now look at the average 14 plus 10 by 2. By the end of the second year, 14 plus 10 by 2. It's only 12%. Look at, is it current year or average earnings? Average earnings of the 2 years is how much? 13%. So 2012 and 13, look at the average. This 14 plus 10 by 2. It will come to only how much percentage? 12%. So whether options are exercisable at the end of the second year? No. Lastly, if the option will vest in the 3 years, if the average earning of the 3 years is how much percentage? 10%. Now check it. 14 plus 10 plus 7. Totally comes to 14 plus 10 plus 7, it comes to 31%, 31%, 31% divided by 10. 31 divided by 10, it will come to what? More than 10%. So what is option vesting? When the option is vesting? By the end of third year. Then look at that. 5,000 unvested options lapsed on 31st March 2012, 4,000 options on 31st March 2013, and 3,500 options on 31st March 2013. So unvested options lapsed are also given to us. Finally, how many employees opted to buy the share? 850 employees, they opted to buy the share within a year. Remaining options unexercised is lapsed. They ask you to pass which one? Journal entries. As I told you earlier, I request you to repeat. Here a logical thinking is also required. Logical thinking is also required. Not only based on this accounting information, some extra thinking you have to make for solving the question. Before we start solving or passing a journal entry, we'll create that provision. What is that provision? ESOP outstanding provision. How much to create, we'll see. So read the question once again. We'll solve it. One thing is not typed. Fair value of the option is 30. Please note, fair value of the option is 30. Fair value of the option is 30. Fair value of the option. Please note it as part of the question. Fair value of the option is 30. Fair market price is already given. Option value itself is given. How much? 30. Don't copy this. Wait. I may make mistakes during this process purposefully to ensure that the same mistake is not carried on in the exam. Three years vesting period. Finally, after how many years the options are exercisable? 3 years. Let me to work out number of options expected to vest. How many options are granted? 1000 into 100. 1 lakh options. 1 lakh options. But look at the question. On 31st March 2012, how many unvested options lapsed? While creating the provision itself, you know that 5,000 options lapsed. Will he create a provision for that? Wait, how many employees were there on day 1? 1000 into 100. How many options? 1 lakh. That is on 1/4/2011. When are we closing our financial accounts first year? 31st March 2012. On the date itself, you know that 5,000 employees are not going to be taking that option or that option lapsed. So you will create a provision for 1 lakh? No. So 1 lakh minus lapsed options. Total lapsed options. 5,000 options. How many options expected to vest on this date? 95,000 options only. First year end, 95,000 options only expected to vest. Okay. Second year, in that 95,000, how many options lapsed? On 31st March 2013, how many options lapsed? Further 4,000 options lapsed. So the provision should be based on how many options? 91,000. The provision should be based on 91,000. Then, and for the third year, how many options lapsed? 3,500 options lapsed. 91,000 minus 3,500. 3,500, how much will be there? How many options will be there? 80? 7,500 options are going to be there finally on 31st March 2014. Wait. Creating and reversing it unnecessary. Creating and reversing that provision is what? Unnecessary. And pay attention. As on, what is the estimated vesting period? What is the estimated vesting period? What is the estimated vesting period as on this date? First date. 1 year. எப்படி 1 year சொல்றீங்க? நான் திங்க் பண்ணுங்கன்னு சொல்றேன். வெயிட் பண்ணுங்க. Estimated vesting period பார்த்தா actual earnings. Actual earnings எவ்வளவு இருக்கு? What is actual earnings given? Adjustmentல கொடுத்திருக்கான் பாருங்க. What is actual earnings? 14%. Required earning 16%. So, wait. Options do not vest in first year. In which year? First year. But wait. What is your actual earnings? What is actual earnings of the first year? 14%. What will you estimate at the end of the first year? If the same 14% earning is going to continue in the next year, if same 14% earning is going to continue in the next year, this year 14%, next year 14%, average will be 14%. Look at the condition. Okay, option will vest at the end of the first year if it is 16%. Option will vest at the end of the second year if the average earnings of the 2 years is how much? 13%. So, okay, options do not vest in the first year. Am I clear in this? Second, wait. If the same 14% is going to continue in which year? Second year also. Then the average will be how much percentage? 14%. So options will vest in second year if average is எவ்வளவு percentage? Read the question. That's why I asked you to read the question. If the average earning of the 2 years is how much percentage? 13%. Clear? So wait. I'm at the end of the first year. My actual earnings are only 14%. Required earning is 16%. So options do not vest in the first year. Options do not vest in the first year. So as an accountant or an estimator or as an auditor, whatever you think, if the same 14% if I'm going to earn in the next year also, first year and second year average earnings will be how much percentage? 14%. So I can estimate that the option will vest at the end of the second year. The average earning is how much? 13%. So estimated vesting period. Estimated vesting period? Years? 2 years. When I'm in first year end, the estimated vesting period is 2 years. So how many employees are there as of now? How many options are there? 95,000 into what is the fair value of the option? 30 into what is the vesting period totally? 2 years. 1/2 I will write off in the current year. 1/2 I will claim it in the current year. Why 1/2? This year half, next year half, like that I estimate and claim. Okay, sir, it is getting extended to third year. That I will come to note as on 31st March 2013 only. When I will come to know that option will vest only in the next year? Only on 31st March 2013 I will come to know. But as on 31st March 2012, estimated vesting period is how many years? 2 years. So I will create a provision also based on this. 95,000 into 30 into 1/2. This is a provision that we will create. 14,25,000 I will create. The journal entry I will pass for this will be ESOP outstanding account date or employee compensation expenses account date or to which one? ESOP outstanding account. How much? 14,12,500. Once again I repeat. Out of 1 lakh options, options already lapsed, how much? 5,000. So what is options outstanding? 95,000 as on 31st March 2012. What is the estimated vesting period? Actual earnings are only 14%. Required earning to get it in first year is how much? 16%. So options do not vest in the first year. Options do not vest in the first year. The reason is you have not fulfilled the required earning. If the same actual 14% continues in the second year also, average of the first 2 years will be how much? 14%, which will be more than the required 13%. So I can estimate that, okay, second year option will be vest. Okay, so based on that I create a provision 1/2. Then let us see the position as on 31st March 2013. Okay, what is the average earning? What is the average earning? First year plus second year by 2. First year எவ்வளவு percentage? 14% plus second year எவ்வளவு இருக்கு actual பாருங்க 10 divided by 2. எவ்வளவு percentage? 12%. it is only 12%. But required averages, eவ்வளவு percentage? 13%. So options do not vest in second year. Options do not vest in second year. Wait. What is my average earning now? Listen. This is logic. No accounting rule. What is my average earning as on 31st March 2013? 12%. So if the same 12% is going to continue for third year also, then the average will be eவ்வளவு percentage? 12%. Okay, for the last 2 years, what is my average? 12%. If the same average rate of earning I'm going to continue in the next year now, the average will be 12%. Options will vest in which year? Third year. If averages eவ்வளவு percentage? Look at the question. Option will vest in the third year if the average is how much percentage? 10%. Okay. Yes. The same 12% is going to continue. The option will vest in which year? Third year. Yes, sir. What is the average required? 10%. So, at the end of the second year, estimated vesting period is how many years? 3 years. First year இருக்கும்போது நான் 2 years நினைச்சேன், but second year வரும்போது it goes to how many years? 3 years. Okay. Now, create a provision. How to create a provision? Now, wait. We cannot create a direct provision also. Why can't we create? Number of options changed. Now, out of 95,000, 4,000 options lapsed. How many options are there now? Only 91,000 option is there now. 91,000 into what is the option price? 30 into cumulatively 2 by 3 should have been recognized. What do you mean by 2 by 3? We are in which year? Second year out of 3 years. So cumulatively 2 by 3 would have been recognized. What is the cumulative expenses? 91,000 into 30 into 2 by 3. How much? 18,20,000 less already recognized. Already created how much? 14,25,000 balance to be created for the second year. Balance to be created for which year? Second year. What is entry you will pass? Same entry only you will pass. Employee compensation expense account to ESOP outstanding account. You have to pass for how much? 3,95,000. I repeat once again, pay attention. Everybody pay attention. Any doubt in first year? Unless otherwise you understand in the class, at home you cannot make it out. Okay, it is tough, but understand it. Pay attention. At the end of the first year, any doubt in this 95,000? How 95,000? 1 lakh 5,000 lapsed. How many options are there? 95,000. At the end of the first year, what is your actual earning? What is your record earning to get the option in the first year itself? 16%. So, are there options vest in first year? No. Think yourself. What is how much you earned in the current year? If the same earning is going to continue in the next year, what will be your average? 14%. As per the problem, it says option will vest in the second year. If the average is how much percentage? 13%. If the average is how much? 13%. So first and second year, if the average is 13%, option is exercisable in the second year. Yes, we estimate that if the same earning is going to continue in the second year also, in the also 14%, next year also 14%, average will be 14%. So as on the first year, what is the estimated vesting period? 2 years. So 95,000 into what is the fair value of the option? Into 30 into y 1 by 2. 2 years na current year of next year of you have to create 14,25,000 we create. When I move to the second year, 4,000 options already lapsed. How many options will be there? 91,000. Average earnings how much percentage? Average earning. Look at the actual average. 14 plus 10 by 2. Eவ்வளவு percentage வருது? 12%. But required average for 2 years, what is the required average? 13%. So whether options vest in second year? No, options don't vest in the second year. But if the same average continues in the next year also, for the past 2 years, what is my average? 12%. The same 12% continues in the next year also. What will be my average? 12% this year, next year also 12% now. My required average will be what? more than 10%. My required average will be more than 10%. So now the estimated vesting period goes to third year. Estimated vesting period goes to how many years? 3 years. So 91,000 options into 30 fair value. Cumulatively, how many, what is the time period over? Cumulatively, what is the time period over? 2 years out of 3 years over. So 2/3 should be recognized. Already this much of provision has been created. Balance you have to create them this year. For this, you will pass a similar entry. What is the entry you will pass? 3,95,000. Sir, you may ask a question. Sir, uniform amount is not recognized. It cannot be recognized. It cannot be recognized when there is a change in vesting period. When there is a change in vesting period.
வந்து 4,000 வந்து cancel பண்றோம் சார். அதாவது general reserve.
See here, wait பண்ணுங்க. Both number of options are cancelled as well as time period changes. ரெண்டுமே change ஆகுது. One is option cancelled. Second, time period goes to how many years? Time period gets what? Extended. So you cannot create accurately the general reserve for that. So ignore. When options period change, don't cancel to general reserve. Next, wait பண்ணுங்க. Third year la wait பண்ணுங்க. What is the average earning? What is the average earning? First year 14 plus 10 plus 7. 14 plus 10 plus 7 divided by 3. What is the average earning? 10.33. What is the required average? 10%. Yes. Yes. Options vest in which year? Third year. Suppose the required average is not coming, whatever was created so far will be transferred to general reserve. Suppose third year average came to only 9%. Options are not accessible in third year also. Then whatever you created, total 18,20,000 will transfer to which account? General reserve. So yes, options vest in the third year. So what is the cost now? Wait, employees changed or options changed? 87,500 into 30. Cumulatively 3 by 3 podla. Otherwise, okay, cumulative figure is 3 by 3. Otherwise, you can just take 87,50,000 into 3 by 3. How much you get?
26 lakh
26 lakhs?
25,000.
Less. You can take either cumulative amount or first year and second year amount. First year amount ever recognized? 14,25,000 recognized. Less second year or you can directly take cumulative amount also. Second year how much is recognized? 3,95,000 recognized. Balance for third year.
8 lakh.
If you understand this question is tested in the exam. 15 marks. Okay. For working this 10 marks, for journal entry 5 marks. For working this 10 marks. Wait பண்ணுங்க. Journal entry will be same. Employee compensation account data to which account? ESOP outstanding account. First year 14,25,000. Second year how much? 3,95,000. Third year how much? 8,05,000. Entry is same. Only the amounts are different. Do you understand? So what is the difference between previous questions and this one? Previous question, we had what? We had same vesting period throughout. But here vesting period gets extended or got extended. Take up this. Examination, don't use columnar format for journal entry. Please pass the entry separately. So this is during the vesting period, 2011, 12, 12, 13 and 13, 14. Over, shall we proceed or wait? Okay, okay, okay. Fast, fast, fast. We'll proceed. Next, when the options are exercised, then we do not know when the option is exercised.
Within 1 year.
Okay. Pay attention. What is the total provision created? Total provision created is how much? 26 lakhs 25,000. How many options are exercised? Pass the entry. Bank account debtor. How many employees opted? 850 employees, 100 options into how much they will pay? 50 rupees they will pay. 850 employees, 100 options into 50 rupees they will pay to the company. Then bank account debtor, ESOP outstanding account debtor. To the extent of 850 employees into 100 options into what is the fair value of the option we accounted? 30.
So 20.
50 is the price they have to pay. 30 is not the option price. 30 is the fair value of the option. I told you fair value of the option. That is the difference between market price and excise price.
But 20 வந்து கொடுக்குறாங்க சார். Choice in the grant 100 stock options 2000 employees for rupees 20 name.
Oh, then, okay. Correct. Sorry. Put 20 there. Sorry. This will be 20. 20. This will be 30. How much? To equity share capital. Take it along with me. No need to wait. To equity share capital. 850 into 100 into face value 10. 850 into 100 into face value 10 rupees. To securities premium. The balance. So we have used only 25 lakh 50,000, but we created 26 lakhs 25,000. The lapsed options we can transfer to which account? General reserve account. ESOP outstanding account debtor. How much you will transfer? 1,25,000. 75,000. 26 lakhs 25,000 minus so the concept of journal entry is the same, but we account it in a different way. The estimates alone keeps changing. Estimates alone what keeps changing. Have a 10 minutes of break, then we will continue. See, always the money collected goes to bank account debtor, that 850 into 100 into 20, ESOP outstanding account debtor 30 to capital to which one? securities premium. Now go to question number 5. Question number 5 might appear like a lengthy story, but the solution will be in 3 or 4 lines. Just go through question number 5. Read, understand, then we will solve. You are going to read, you are going to understand, then we will solve. Read it, I mean it. Please read the question full, then we will solve. From the first 3 lines, what do you understand? 1,000 stock options. Then, what is the vesting period? 3 years. The exercise price is 40. However, if the exercise price drops to 30, the earnings of the enterprise increase at least by 10% over 3 years period is given. On the grad date, the enterprise estimated that the fair value of the option with an exercise price of how much? 30 is 16 per option. Which means this is on day 1, we are estimating this. Then read further. If the exercise price is 40, the enterprise estimates that the fair value will be how much? 12 per option. During the year 1, earnings of the company increased by how much percentage? 12%. Earnings of the company increased by 12%. Here, at least there should be an average of how much? 30. At least it should be increasing by 10. 12. The earnings will continue for 2 years. Therefore, they expect the earnings or the target to be achieved. Hence, the stock option with an exercise price of how much? 30 is valued. So, all these things are the estimates for which year? First year. All these things are the estimates for the first year. Then, during the year 2, the earnings increased by how much percentage? 13%. The enterprise continues, the same target will be achieved. So first year or second year, average earnings are more than 10%. Average earnings are more than 10%. So they are considering the fair value of much? What is the exercise price? 30. If exercise price is 30, if the exercise price is 30, what will be the fair value of the option? 16 per option. If the exercise price is 30, fair values 16. During the year 3, earnings of the company increased only by how much percentage? 3%. Therefore, the earnings or target could not be achieved. If an employee completes the 3 years of service and because of the service condition, since the targets are not achieved, 1,000 vested options with an exercise price of how much? 40 is given. If exercise price is 40, what will be the fair value of the option? 12 rupees. Now read it once again, you will understand all this exercise price, all those things. Question number 5. How many options? Or how many options? 10,000 options. If exercise price is 30, fair value of ESOP is how much given? 16. If exercise price is 40, fair value of ESOP is 12. Okay, wait. When exercise price of 30 will happen? If average earnings are below 10%. Below 10%, na, exercise price will be what? 30, fair value will be 16. If average earnings is above 10%, or you can say 10% or more, 10% or more or above 10%. At least average 10% or 10% or more. Then the exercise price is how much? 40. where the fair value of the option will be taken at what? 12. Okay, wait. At the first year end, okay, what is the vesting period? How many years? 3 years. Vesting period did not change in this question, right? At the first year end, what is the average earnings of the company? Or what is the earnings of the company? At the first year end, what is the earnings of the company? Earning increased by how much percentage? 12%. So, if the earnings is above 10%, this will be the provision. This is how you have to create the provision. Earnings of the company is 12%, or earnings of the company increased by 12%. Increased by 12%. So, if average earning increases 10% or more, the excise price will be 40. Fair value of the option is what? 12. So, ESOP cost will be how many options? 10,000 options into what is the fair value you will take now? What is the fair value you will take now? Will you take, wait. Oh, sorry. Sorry. Go through that. Go through the question once again. Excise price drops to 30. The earnings of the company increases by at least what? 10%. Sorry. I have written wrongly. If the earnings is below the, sorry. Sorry. Read the question once again. Look at the words used. The enterprise expects that the earnings will continue in the next 2 years. Therefore, the enterprise expects the earnings target will be achieved. Hence, the stock price will have an excise price of how much? 30. If excise price is 30, what is the fair value of the option? 16. Actually, the confused panadramla. So, average earnings are 10% or more, excise price is 30, fair value of the option is what? 16. So, 10,000 into 16 into 1 by 3. Why 1 by 3? 3 years. 10,000 into 16 into 1 by 3. This is the expense to be recognized for the first year. This is for the first year. Okay, journal entry they have not asked. Look at the question. Do they ask you journal entry? What is the question? Calculate the amount to be charged on account of which one? To be P&L account on account of employee compensation expenses. So, this is the amount, or you can say this is a cumulative amount and this is a current year amount also. Then, this is for the first year end. Pay attention. Second year end. What is given second year end? Read question. Year end, year 2, earnings percentage of the company is how much? 13%. So the enterprise continues to expect the same earnings target to be achieved. So in year 2 also, earnings of the company increased by how percentage? By how much percentage? 13%. So if the average earnings is 10% or more, excise price is going to be 30 and fair value of the option will be what? 16. So second year also ESOP cost will be 10,000 into 16 into cumulatively 2 by 3 you can put. 2 by 3 you can put. So first year you will recognize this much. Second year cumulative amount minus the first year amount. Okay. Then look at third year what happens. Third year and also during the third year earnings of the enterprise increased only by 3%. So 3% na, average will be average is below 10%. Below 10%. Therefore excise price will be what? Look at the question. Therefore, the target is not achieved. Okay. The excise price will be how much? 40. If excise price is 40, fair value will be 12 rupees. So for the third year, we'll create the provision based on 16 rupees fair value or 12 rupees fair value. So ESOP cost for the third year will be, I'll address first year, second year, and third year. 10,000 into 12 into 3 by 3 over. 10,000 into 12 into 3 years period is complete. How much it will be? 1,20,000. So expense to be recognized for the current year will be 1,20,000 minus this one. This is the ESOP cost. So this amount you will charge it in P&L account. This amount you will transfer it in which account? P&L account. First year 53,333, second year also, third year. Since the fair value changed, amount recognized is different. Amount recognized is what? Different. That's all. This is your answer. For this question, this is the answer. That's all. Do they ask you to pass journal entry? No. They don't ask you to pass journal entry. You don't believe it? It's an ICA question only. This is a question. Illustration 7 in your ACA material. You can see the solution. What is the solution? Expense for the year and cumulative expense for the year. Okay, by looking at the question, don't get panicked. Simple. First year, how many options? 10,000 option. What is the vesting period? 3 years. What is the fair value of the option? Why are you taking 16? Because our earnings are more than 10%. So excise price will be 30. Fair value of the option is how much? Otherwise, if earnings, see, the concept of the problem is, if the company earns more, the employees can buy at a lesser rate. You understand? If earnings are more than 10%, growing more than 10%, employees are offered at a lesser rate. You can buy for 30 rupees like that. If earnings are falling below 10%, you have to pay a higher rate to buy the share. That's why second year and also the same trend continues. Look at third year. Earnings are averaging below 10%. Now employee should pay how much for the share? Employee should pay how much for the share? 40 rupees for the share. For that, the fair value is estimated at what? 12 rupees. Simple. You pay less, the value of the ESOP is more. You pay more, the value of the ESOP is less. Otherwise, simply fair value is given for first year, second year, third year, excise price changed. So fair value changes, recognize that expense. This is nothing but in your study material illustration 7. No information regarding lapse of option is given. So throughout all the 3 years, 10,000 is maintained. Shall we? Come to question number 10. Come to question number 10. Remaining questions, of course, we will do. Question number 10 part. It's a very good question again. Have we copied this over? Okay, take it up fast. Take it up fast. Those who completed, please read question number 10. It's a very good question. Please read question number 10. Again, that appears very lengthy, but very simple to solve. Question number 10. If they ask you accounting entry, very simple. What is the entry? ESOP, there is employees compensation expense accounted out to ESOP outstanding account, P&L accounted out to ESOP outstanding. 3 years you will repeat the entry. Please read question number 10 after this. போறாது. அப்படி என்னங்க இவ்வளவு நேரம் காப்பி பண்றீங்க? 3 லைன் போறா. குட். Shall we? There is a small change you have to make or strike off you have to do. This and the 100 will move on. How many employees covered? 300 employees covered. What is the nominal value per share? 10. What is excise price? 40. Face value is 10. Excise price is 40. What is the fair value? 20. You should be in continuous employment up to 31st March 2011. So how many years covered? 8, 9, 9, 10, 10, 11. 3 years covered. 3 years covered. Okay, please strike out that 100. Okay. But options are exercisable in July 2011. Okay. But number of options are not given. How many employees are covered in this? Pay attention. How many employees are covered? 300 employees are covered. But the number of employees number of options are fixed. No, please read the question. Then you will have a difficulty in understanding. Please read. If the profits are less than 100 crores, number of options per employee will be what? 0. If you estimate that the profit earned by the company is less than 100 crores, no option will be exercised by the employee or no share will be given to the employee. Then, if profit is 100 to 120 crores, what is options given to the employee? Each employee can buy how many shares? 30 shares. 120 to 150 crores profit means 45 shares. Above 150 crores means how many shares? 60 shares you can buy. Now, at the end of the first year, the company is expecting to earn how much? 115 crores on an average, and number of employees entitled for an option is how much? 280. So we can also work out, maybe I'll classify this into first year end. First year end, how many employees are there? What is the estimated profit after tax? Average profit after tax? 115. So therefore, wait. How many options will be given? Look at the table. If profit after tax is more than 100 crores, okay, how many options are given? More than 100, less than 120, 30 options. So how many employees expected to exercise the option on this date? 280 employees into 30 options into what is the fair value? 20 into 1 by 3 into 1 by 3. So this will be the cost for the first year. 280 into 30 into 20 into 1 by 3. 56,000 is expense to be recognized for the first year. First year. This is on what date? 31st March 9. Then 31/3/2010, that is second year end. It's a simple question. What is the estimated average profit after tax? 130 crores. So number of options will be 45. So how many employees are there? 270 employees into 40 options into what is the fair value? 45. No. Profit after tax, oh, 45. 45 into 2 by 3 should have been recognized. Okay, 20 into 2 by 3. Because cumulatively this expense should have been recognized. 1,62,000 cumulative amount less first year amount. What is the first year amount? 56,000. So this expense would be charged in the second year. 1,06,000 on 31/3/2011. That is third year end. Okay, what is the average profit given? Actual is known to us. 128 crores. So number of options will be 45. How many employees are there on this date? 275 employees are on this date. 275 employees into 45 into 20 rupees per option into 3 by 3
247,500.
cumulative. 2
47,500.
less first and second year amount. So third year amount will be how much?
8,800.
This is the expense to be recognized. Take up this.
தேர்ட் இயர் வந்து எம்ப்ளாயி வந்து ஏறாங்க சார், என்ன சார் ரீசன் இருக்கும்?
Expectation now. It is only an estimate.
Base
It is only an estimate. Probably labor turnover would have reduced. Okay, first year, second year, I mean, labor turnover would have been like 3%, 4% estimate பண்ணிருப்போம். Okay, third year onwards, the mentality of the employees would have changed. Let us not change the company insulated. Probably insecurity of job outside the company, so they would have stayed in the company. So it is only an estimate. Pass a journal entry also. They ask you to pass journal entry, இல்லையா? Amount தான் கேட்டிருக்கானா?
expenses up to for feature.
So total amount created is 2,47,500. $2,47,500. That is creative cumulatively over a period of 3 years. Okay. ESOP to be adjusted. எவ்வளோ employees? 270 employees into how many options? 265 employees. Okay, 265 employees into 45 into 20 rupees.
2,35,000.
2,38,500. So ESOP to be transferred.
Furniture का तो general से
General reserve. ESOP to be cancelled. This is known as forfeiture. You can pass journal entry also. Bank account data, how much you will collect? Excise price, how much is given? 40. 265 employees into 20 options into 40. 45 into 40. ESOP outstanding account data will be this much. To capital 265 into 45 into 10. We'll transfer to general reserve. Go to question number 9 next. I hope 10th question, they have not asked journal entry, but still. Check the grant date, 1st April 2011. How many employees? 50 employees. How many options? 1000 options. Fair value is given as 9. 3 years. 3 years continuous employment is given. If the share price is 70 rupees, the fair value of the option is 9 rupees. If share price is, how much? If share price is how much? 70, fair value of the option is 9. Estimated number of employees are given. At the end of the first year, only how many employees? 48, then 47 employees. Number of employees actually satisfying the condition at the end of the third year is only 45. Share price was 68 when intrinsic value is how much? 8. Wait, this happens in 2013-14. 2013-14. Journal entry is simple. Okay, so we'll just estimate. We can just prepare a table. This is question number 9. Pay attention. First year end. First year end means on 31st March 2012. How many employees are there? 48 employees. Into what is the number of options per employee? 1000. Into what is the fair value? This into 1 by 3. Fair value how much? 9. This is the expense for the first year. On 31st March 2013, how many employees are there? 47 employees into 1000 options into fair value at that date also we estimate 9 da. Cumulatively 2 by 3. So this is cumulative expenses. How many employees? 45 into 1000 into what is the fair value? Revised at 8 rupees into 3 by 3. Fair value of the option.
Intrinsic value and face value.
Intrinsic value is nothing but the difference between, sometimes they use the word fair value, intrinsic value. Okay, intrinsic value might be a present value of that option. Difference between fair market value and excise price is called as which one? Fair value. Probably the present value method use பண்ணி time value of factor you consider and work out what? That is called as present value. Probably that can be taken as what? Intrinsic value. Journal entry you can do at home. Entries are going to be same. They ask you journal entry only for how many years? Expense to be recognized. Fair value is reduced. Simple. For the employee, it is like a loss. Okay. When the shares are selling in the market at 70, the intrinsic value is taken as what? 9. Since the share value is reduced, option value also gets reduced. We cannot decide because number of employees changed. How much to write off, how much to reverse, it's difficult to work out. That's why the current year expense, it will be recognized in P&L. It's only No, 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 it's not given so.
Share price is 70 or
Options vested employees 3 years on the vesting date, provided that the share price is how much? 70 or above at the end of 2013-14 கொடுத்திருக்காங்க. The share price at the end of 13-14 was 68 when intrinsic value was revised at what? 8. Since intrinsic value is given, we are recognized like that. So which questions are pending? 7th and 8th, try it at home. I'll provide the solution in video form or in PDF form. Okay, I will add it in the drive itself. Okay, so in video form, because we have done more than sufficient in ESOP. Okay, so classroom sums plus that homework sum, if you are thorough, that is more than sufficient. Okay, as I told you earlier, minimum 10 marks is from this chapter. Every attempt they ask for minimum 10 marks. Okay, based on the last class questions are asked, it will be for 5 marks. Today, whatever we have done. Okay, now vesting conditions change, number of employees change, fair value change, okay, or vesting period change. With that, if they ask you, it will be for 15 marks. You get it easily from this chapter.